SEBI has announced three major changes to mutual fund regulations that will directly benefit investors investing in mutual funds. Today, I'll break down exactly what these changes mean for your investments and specific actions that you need to take to protect and optimize your portfolio. The first significant change involves new fund offers or NFOs. So previously, when you invested in a new mutual fund during the NFO period, the asset management company, which is the AMC, had up to 60 days to deploy your funds. This meant your money could potentially sit idle for up to 2 months before being actually invested into the markets to the fund's mandate. Under the new rules, this deployment window has been cut down to half, which is thus 30 days. So this is actually a positive change if you are an investor because it reduces the time your money sits uninvested, potentially improving your returns over time. But here's the real game changer that many investors are missing out. SEBI has added a powerful protection mechanism. So if the AMC fails to deploy this fund within 30 days time frame, now you have the right to withdraw your money without paying any exit load or penalty. This is unprecedented protection for investors, especially valuable for NRIs who often have to manage their investments remotely. This also means that you should now include deployment speed as one of the criteria when you're evaluating your NFOs, the new coming offers also. AMCs with strong operational capabilities will likely deploy your capital faster and with a strategy, potentially giving you a better head start with your investments. The second significant change SEBI is implementing is mandatory stress testing for mutual fund schemes. Now, this might sound a bit technical, but it's actually quite straightforward and incredibly important for you and for your financial security. So, stress testing is especially a simulation that tests how a mutual fund might perform under various challenges and market scenarios. It's like putting the fund through a financial obstacle course to see if it can withstand extreme conditions without collapsing. So under the new regulations, mutual fund companies will be required to regularly subject their schemes to stress tests, and the reports of these results have to be made public. This gives you unprecedented visibility into how resilient your investments might be during any market downturn or any kind of global financial crisis. For you as an investor, this change is particularly valuable because as of now, you can evaluate schemes only based on how better they have performed during any events in the market. But by investing in the funds that have demonstrated resilience also, when the market falls, it adds an extra layer of protection to your portfolio. So there's a practical tip that I want to give you. Once these stress test results become available, I recommend reviewing them alongside your financial advisor to identify any potential changes in your current investment allocation. This is especially important if you have significant exposure to debt funds or funds with less liquid underlying assets. We as a firm managing around 350 crores of investments are already planning to incorporate stress test results as a key criteria in selection of our mutual funds. A fund that performs well under normal conditions but fails stress test might not be a suitable option for our investors who are NRIs and they can't actually monitor their portfolio while they're outside of India. The third and perhaps most fascinating change is called as skin in the game rule. SEBI has mandated that employees of the asset management companies must have a portion of their compensation directly invested in mutual funds. These funds are the managed or the funds which are overseen by the AMC. This might seem like an internal HR policy at the first glance, but it's actually a powerful alignment for interests between fund managers and investors like you. When people are managing your money, they have their own financial future also tied to this performance of the fund. So naturally, they are incentivized to make sure that they are giving you the best and the prudent investment advice and decisions. As someone who has been in the financial industry for over a decade now, I can tell you that this is a significant shift in the accountability. The fund managers and all other employees of AMC will now personally feel the impact of their investment decisions, just like you do during market downturns. In practical terms, this means that you might want to consider funds where fund managers have voluntarily chosen to invest a significant portion of their personal wealth beyond the minimum required. Such voluntarily skin in the game can be a strong indicator of fund managers' confidence in their own strategy and the fund's prospects. This change offers an additional layer of confidence. One thing to note here is that there are AMCs who have already implemented this model from very early days, even when SEBI hadn't made it mandatory. And I want to emphasize that while these regulated changes are significant and they represent enhanced protections and transparency also that benefit you as an investor, you have to make sure that you choose your portfolio wisely. The key is to stay informed and to be proactive and work with advisors who understand both Indian market regulatory landscape and also your life specific unique considerations. That's exactly where my team and I specialize, helping NRIs navigate these complexities while optimizing for growth and compliance both. So if you found this breakdown helpful, don't forget to hit that subscribe button and join our exclusive NRI only WhatsApp community for more such timely updates on regulations that affect your investments. The link to join our WhatsApp community is in the description below. Thank you, and I'll see you in the next.